Yeah, we're good.
Okay, I'm sorry. Hi. So today we're going to be presenting Walmart's financial analysis report that we came up with. My name is Nicole,
I'm Thomas.
I'm Jeremy.
and this is our presentation. So starting off with the introduction, Walmart was founded in 1962 by Sam Walton in Rogers, Arkansas. The company's mission is always to help people save money and live better through low prices, convenience, and accessibility. If you move on to the next portion about global markets and industry presence, Walmart operates through Walmart US, Walmart International, and Sam's Club. The company has stores and online operations in countries such as Mexico, Canada, China, and India. The company specializes in grocery retail, general merchandise, health products, clothes, electronics, and e commerce fulfillment services. If you move on to the next part, about key product lines and revenue sources. Most of Walmart's revenue is derived from retail sales across a variety of category of goods. Their main source of revenue is their grocery sales, and then is followed by health and wellness products, clothes, electronics, and etc. Walmart continues to expand their online ordering, digital advertising, and fulfillment services, which makes their e-commerce an increasingly valuable revenue source. Walmart also makes money from financial services, pharmaceutical operations, and external marketplace merchants as well on its online platform. When it comes to Walmart's business strategy, Walmart's strategy focuses on low prices, operational efficiency, and customer convenience. The company invests heavily in technology, automation, online shopping, same day delivery, and fulfillment centers to improve customer service. Walmart's strategy recently has been their digital transformation. To compete with larger online retailers, the company has extended its e commerce, mobile applications, delivery services, and data analytics services as well. Walmart is also strongly focused on developing its grocery sector, which makes up a huge part, again, of the company's revenue and contributes to consistent customer traffic to its stores. Moving on to the competitor identification and competitive positioning. Walmart competes with companies like Amazon, Target, Costco, and Kroger. Despite strong competition, Walmart remains successful because of its massive supply chain, strong brand image, and low price strategy. Despite strong competition, Walmart does remain having significant competitive advantages because of its low price guarantee and its slogan everyday low price strategy attracts price sensitive customers, particularly during times of economic instability and inflation. This really puts Walmart at a competitive advantage, because like stores like Target, they focus more on like quality and the experience in the store, while Walmart is really heavily zoning in on having lower prices. Key economic factors that are impacting Walmart. Important economic factors affecting Walmart include inflation, fuel costs, labor expenses, and changing consumer shopping habits. These factors impact product prices and company operations. If you took a look at the balance sheet and the income statement, um, these financial statements demonstrate a highly efficient, scale driven retail business model. Walmart's balance sheet clearly shows significant investment in inventory, property, and equipment, which reflects the company's strong supply chain and retail infrastructure. Although liabilities remain relatively high, continuous cash flow and profitability contribute to the company's financial stability.
Nice, Nicole. So now we're going to move on to the value chain analysis. So as we see right here, we have a chart, oh, of the value chain analysis. It's a little bit tight that we can see, but there we go. Thank you, Thomas.
Yep.
So we have the primary activities for inbound logistics. Walmart works closely with thousands of suppliers worldwide to source products at competitive prices. Competitive prices. The company uses advanced inventory management systems and cross-docking techniques to reduce costs and ensure product availability. Then we move on to the operations. Walmart operates thousands of stores, clubs, and distribution centers globally. The company focuses on operational efficiency through automation, data analytics, and leans processes to reduce costs and improve productivity. We move over to outbound logistics. Walmart's extensive distribution network ensures efficient movement of goods to stores and customers. The company supports online orders, curbside pickup, and same day delivery through strategically located fulfillment centers. Then we move over to marketing and sales. Walmart uses its everyday low price strategy, digital advertising, and promotional campaigns to attract price sensitive customers, loyalty programs, and Walmart Plus membership to enhance customer engagement. Lastly, we have service. Walmart provides multiple customer service channels, including online support, pharmacy services, delivery options, and Walmart Plus benefits to improve customer satisfaction and convenience. And then we have our support activities with firm infrastructure, our human resource management, technology development, and procurement. Then we have the evaluation of market share and strategic positioning. So the U.S. grocery dominance. Walmart's strongest competitive position is in grocery retail, as we know. Walmart controls roughly 20 through 21% of the U.S. grocery market, making it the largest grocery retailer in the country by a wide margin. Fiscal 2025 U.S. grocery sales reached approximately 276 billion, accounting for nearly 60% of Walmart U.S. revenue. Its scale advantage comes from more than 4,600 U.S. stores, with around 90% of Americans living within 10 miles of a Walmart location. So we move on to the e-commerce position. Walmart is the clear number two player in U.S. e-commerce behind Amazon. Walmart's U.S. e-commerce market share is estimated around 6 to 7%, compared with Amazon's dominant share near 38%. However, Walmart has become the largest online grocery retailer in the U.S. with approximately 29% share of grocery e-commerce. Walmart's digital business has become profitable, a significant milestone after years of investment. Its growth is driven by curbside pickup, same day delivery, Walmart Plus subscriptions, marketplace expansion, retail advertising revenue. Strategic positioning. Walmart's positioning can be understood through five major strategic pillars: cost leadership strategy, which includes supply chain scale, inventory efficiency, operational automation. This allows Walmart to remain resilient during inflammatory periods because consumers trade down toward value retailers. Analysts increasingly describe Walmart as both a defensive retailer during economic slowdowns and a growth company because of the digital expansion. Omnichannel retail leadership. Walmart's most strategic transformation has been from a pure brick and mortar retailer into an omnichannel platform. The company leverages stores as fulfillment hubs, pickup centers, last mile delivery nodes. This is strategically different from Amazon's warehouse centric model. Walmart's advantages include lower last mile delivery costs, faster grocery fulfillment, reduced shipping dependency, easier returns, local inventory visibility. Also, the same day delivery network now makes everything worthwhile as well. Ecosystem expansion. Walmart is no longer just a retailer, it's a building a broader consumer ecosystem through Walmart Plus, the subscription. And the subscription includes free delivery, shipping benefits, fuel discounts, streaming partnerships, scan and go shopping, making the consumers life easier and more convenient. Advertising. Walmart Connect is becoming a high margin revenue engine. Ad revenue growth exceeded 24 through 30% in several recent quarters. Retail media is strategically important because it improves profitability far more than traditional retail sales. The marketplace strategy. It's aggressive in third party marketplace to broaden assortment without carrying all the inventory directly. And then the technology into automation positioning as well. With AI demanding forecasting, fulfillment center automation, delivery optimization, digital personalization, marketplace infrastructure. Automation reportedly reduced handling costs by roughly 20% in the next generation of fulfillment centers. This matters because retail margins are thin, so efficiency gains compound significantly at Walmart scale. Then we have broad consumer research. Some recent growth increasingly from the middle income shoppers, affluent households earning over 100K annually. This broadens Walmart's competitive positioning against Costco, Target, Amazon. Walmart's improved store design Fashion offerings, convenience services, and faster delivery have helped shift consumer perception upward. Then we have some key strategic risk. So, our risk would be Amazon competition, grocery margin compression, labor costs, tariffs, global sourcing risk, slower grocery share gains, marketplace competition. But the impact, we have e-commerce pricing and logistics pressure. Grocery has lower profitability. Wage inflation pressures on operating margins could raise costs on imported goods. Some data shows slight share erosion recently, but also Amazon still dominates third-party seller ecosystems. Now we get into the strategic positioning. Walmart's competitive position is unusually strong because it combines the physical scale, digital infrastructure, logistics capability, grocery dominance, value pricing, and membership economics. The company's biggest strategic achievement has been transforming from traditional discount retailer into a hybrid. So it's part retailer, part logistics network, part advertising platform, part technology ecosystem. So it's a whole bunch coming into one for Walmart. That diversification gives Walmart stronger long-term defensibility than many traditional retailers. While Amazon remains stronger in the overall e-commerce and cloud technology, Walmart arguably holds the strongest omni-channel grocery position in the U.S. retail market today. Yes. Okay. Short short-term liquidity and long-term solvency issues. So, Walmart maintains a strong financial stability through consistent cash flows, efficiency inventory management, and moderate leverage. So, although its current ratio is often below 1.0 consistent sales and strong supplier relationships, it allows it to meet short-term obligations easily. Walmart's debt levels are manageable because of stable earnings and strong cash flow. As you can see in our capital structure below, moderate leverage lowers financing costs while maintaining investment grade flexibility. The company also continues investing heavily in infrastructure and digital growth while improving inventory efficiency and overall asset utilization.
All right. Now we're going to move on to section 4 with the company's Z-score analysis. So we looked at two things: Walmart's Z-score to assess their financial health and their current market ratios to understand how investors are valuing the company today. Starting with the Z-score, we used the Altman Z-score model, which is a modified version designed specifically for non-manufacturing companies like retailers. Um, the way it works is it takes 5 financial ratios, weighs them, and adds them up to give you a single number that tells you how close or far a company is from financial distress. For Walmart, we calculated a Z-score of 5.5. To put into context, anything above 2.9 is considered a safe zone, meaning low risk. Um, uh, and Walmart is sitting at almost double that threshold, so they're extremely strong territory. The two biggest drivers of that score were X4, so it's going to be the um, up here. It's going to be our variable for X4, whatever you want to call it, the market cap slash total liabilities, which is um, their market cap about $1 trillion compared to 178 billion in liabilities. So that ratio alone is enormous. And X5, which is their asset turnover, meaning they're generating about $2.48 in sales for every dollar of assets they own, which is very efficient for a retailer of this size. The one number that looks a little odd is X1, working capital, which is actually negative, but that's completely normal for Walmart and for large retailers in general. They collect cash from customers every single day, but they pay their suppliers on 30, 60, sometimes 90-day terms. So they're intentionally running with negative working capital, and it's actually a sign of their bargaining power over suppliers, not a weakness. Moving to their market ratios, um, moving to their market ratios, Walmart's trailing PE right now is about 47.75x. For reference, the retail sector averages around 25 to 30. times their earnings. So Walmart is trading at a significant premium. What that tells you is that the market isn't just looking at Walmart as a grocery store anymore. Investors are pricing it like a growth company because of the advertising business, the Walmart Plus membership program, and the e-commerce expansion. These are higher margin revenue streams that are growing faster, and the market is rewarding that. The EV slash EBITDA of 20 times X, 25x, and the PB of about 10.4x, telling a similar story. Premium valuation across the board. The dividend yield is fairly low at 0.76, which shows the company is prioritizing reinvestment and share buybacks over paying out cash shareholders. And to bring it all together, Walmart shows up as a financially stable and resilient across every dimension we analyzed. Liquidity is strong operationally, even when with negative working capital. The capital structure is well managed with debt used strategically. Asset utilization is improving. Profit margins are expanding, and the Z-score confirms there is virtually zero risk of financial distress. The premium market valuation is justified given how much Walmart has diversified beyond traditional retail. So now, if we are going to move on to Section 5. All right, so for Section 5, we have the appendices. And right here we have total assets, right? So, and then we also have total liabilities, right? So a few things worth pointing out here. Total assets grew from 252 billion to 284 billion over a 3-year period, and the biggest driver of that was property, plant, and equipment, which combined 130 billion to nearly 157 billion. That's Walmart pouring money into stores, fulfillment centers, and logistics infrastructure. On the liability sides, accounts payable is the largest single current liability at over 63 billion, which again ties back to Walmart's ability to delay payments to suppliers. That's working capital management in action. Total equity grew steadily from 90.6 billion to 106.2 billion, showing retained earnings building up year over year. Basically, for the common size balance sheet, it expresses every line as a percentage of total assets. And the most notable trend here is PPE going from 51.6 of total assets up to 55.1%. Confirming that Walmart is becoming more capital intensive as it builds out infrastructure. Inventory and as share of total assets actually decrease slightly from 21.7 down to 20.7 from full year 26 to 25, which is a good sign. It means that they're managing inventory more efficiently even as the business grows, and the liability side, total liabilities as a percentage of total assets actually declined from 64.1 to 62.7. Overall, the appendices give us a full picture to support every conclusion we drew in the analysis. Consistent growth, improving margins, disciplined capital management, and a balance sheet that is getting stronger year over year. Here's our works cited, and I know that you can't really see me because we had a technical difficulty throughout the meeting because Zoom didn't let me have the meeting go on for past 40 minutes, but I hope that you liked our report. I think we all did a lot of work on it. We actually fell short of one of the people that worked on it with us. That's why it's just Nicole, Thomas, and Jeremy. I forget the gentleman's name, but we did have another teammate that just did not end up responding to us. So whoever was in our group, other than him, you do what you got to do. But yeah, that's been Walmart's project. So thank you so much, and have a great summer.